Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a consolidation where we have a parent-subsidiary relationship, the parent owning a controlling interest over 51% but not 100%. Therefore, we will have a non-controlling interest we will be dealing with. Our major focus will be the fact that P, the parent, purchases S bonds, the subsidiary bonds. However, the subsidiary did not issue them directly to P, they issued them to some other party, and then P purchased S's bonds from another party, which will complicate things a little bit. The mirroring of the transactions related to the bonds between the parent and subsidiary not being as straightforward or clear as if one had simply issued the bonds to the other. This will be part 1 of 2 in this presentation or in this practice problem. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. We're going to go through the information related to the practice problem, and then we'll take pieces of this information as we work through parts and components of the practice problem. So here we have P purchased a percentage of S, P the parent, S the subsidiary. P purchased the voting stock of S on January 1st, 2000X0. So that's the point in time that the purchase took place. The controlling interest or portion that was purchased by P the parent, 75%. Then we have the non-controlling interest is going to be the 25%. In 2000X4, P resold inventory transferred from S in 2000X3. So that's going to be the year of consolidation, 2000X4. So we're going to have this intercompany transaction related to the inventory. Once again, 2000X4, P resold inventory transferred from S in 2000X3. So basically in the prior year, S sold inventory to P, which P basically resold in the current year. The cost to S is going to be $53,000 when they originally, the cost to them that they sold in the prior year, 2000X3. Cost to P then, the $68,000, that's what they purchased it for last year. Then in 2000X4, P purchased inventory for the $49,000. That's in the current year that we will be consolidating, 2000X4. The parent purchased $49,000 inventory, sold it to S for $69,000. So now we have a sale from P to S of that inventory. And then in 2000X4, S still is holding on to $31,050 of that intercompany transfer inventory that we'll have to deal with. Then S issued bonds on January 1st, 2000X1. The face amount of the bonds are $190,000. Note, we're not saying here that S issued them to P. S simply issued the bonds. So we don't have any kind of problem with intercompany kind of transfer at this point in time, but then P's going to purchase some of those bonds from a third party, and that's where the problem happens. But in any case, right now, no problem thus far. S issued the bonds, face amount $190,000, interest 8%, years 10, issued at 104. In other words, a premium 104 or 104% of the $190,000 face amount is what they are originally issued for, that then being a premium that would result. P purchased bonds from one of the original owners on December 31st, 2000X2. In other words, P is purchasing S's bonds here. So S issued the bonds to someone not related, and then P purchased those bonds from somebody not related, but they're S's bonds. So now that we have this problem that we'll have to kind of deal with, or that we'll have to deal with in the consolidation. So the bond face amount is $76,000. So that means $76,000 of the original issuance of bonds by S, $190,000, were purchased by P. Now they purchased them for only $74,480. So that means on their books, they see it as a discount. They purchased it basically at a discount, even though the original item was a premium. When S issued the bonds, they issued them at a premium. Obviously, the interest rate is going to be the same, and we have the same kind of maturity date that will be related to these bonds as well. So we'll get into that. Then we're going to use the straight line method write-off for the premiums and the discounts. We're just going to use the straight line method so we can analyze this a bit more easily. We'll have the interest paid annually on December 31st. So annual interest, not semi-annual. So it's just an annual interest as of the end of the year. So we don't have any kind of accrual issues we'll have to be dealing with as we go to this kind of a little bit more complex transaction. Fully adjusted equity method is used, and we're going to consolidate as of December 31st, 2000X4. So that's going to be the time of consolidation. Okay, so we got a few different things we're going to be combining together in one kind of longer problem here. Let's take a look at those intercompany transfers of inventory first. Now, first I want to just go through the 4 scenarios that you can kind of have just so you can see how you might want to put a worksheet or think about it, visualize in your mind, and then we'll just put in the items that are necessary for this particular problem. So we have then, you could have basically prior year downstream transactions being from the parent to the subsidiary. So we want to think, okay, we could have prior year downstream transactions, parent to the subsidiary. Those are important because the ending inventory could be reflecting gross profit that we'd then have to kind of like do a reversing component that would be sold in the current year and whatnot. So we have the prior year downstream transactions, and then we can have these three relate to them, the orange ones, and then the current year downstream transactions, right? Current year downstreams from parent to subsidiary. And then we could have then the upstream transactions, including the prior year upstream transactions. That would mean from the subsidiary to the parent, and these three green items are related to them. And then the current year upstream transactions. So those are kind of like the four components of these transactions you want to consider and think about. Then I'm just going to fill in the ones that are applicable here with regards to the data that we have with the intercompany transactions. Now I scrolled back up to the data so we can see the data here. This is going to be 2000 X4 P purchase inventory for the 49,000, and then they sold it to S. So that's going to be a downstream transaction in the current year for the 69,000. S is still holding on to the 31,050. So I'm going to consider that. We're going to go back down and say, all right, that's going to be this item down here in the yellow. This is going to be a current year downstream transaction. So we'll think about the sales side of things. We said that we had the sales price at the 69,000. So 69,000 on the sales, the cost of goods sold 49,000, and then the gross profit is going to be the 20,000, the 69 minus the 49. If we were to figure the gross profit percent, notice it's not an even percent, so it's a little bit, we've got to be careful here. It's going to be the 20,000 divided by the 69,000, and that would be the 0.289. So just note that you're going to have rounding. It rounds to about 29%. So then what is given to us is the amount that's still on hand. So the amount that is still on hand is going to be the 31,050. So I'm going to say they didn't give us the amount resold. We can back into it, reverse into the amount that is resold. But I'm going to go down to the sales down here. So we've got the 31,050. And then we can kind of figure out the gross profit by using that percentage. Again, note that there's rounding involved. So you gotta use the ratio. So I could say then, here's my rounded item. I'm going to take this times the 31,050. And that's going to be the 9,000. So there's the 9,000. Then we can back into the cost of goods sold, taking that 9,000 minus the 31,050, that being the 22,050. So now we have the ending amounts and we have the beginning amounts. We could figure out the amount that is resold. And I know I'm doing this a little bit quickly because we focused more on this in prior presentations. So if you want to focus in on this area, you can go back to those prior ones and look into them. But now we're going to take the 69,000. So we'll take the 69,000 minus what we have down here, which is the 31,050. That's going to be the 37,950, the amount that is resold of the original sales price. And then we got the 49,000 of the cost of goods sold minus then the 22,050. That's going to give us the amount of the 26,950. Then we can take the 37,950 minus the 26,950. And that gives us our 11,000. If we take that and divide it by the sales price, the 37,950, we get to our same about 29%. So we're going to be using that in one of our first consolidation entry adjustments. And we're going to have to make some intercompany adjustments related to the inventory. Now, the other inventory item we have, I'm going to jump back up to our data. We have then in 2000 X4, P or the parent resold inventory transferred from S, the subsidiary, in 2000 X3. So the cost for S is going to be the 53,000, and the P's cost is going to be the 68,000. So this is what P resold in the current year. So we think about this as a prior year transaction because we're talking about something that S sold to P in the prior year, and then P sold it in the current year. So it's a prior year transaction that had stuff left in ending inventory that was then sold in the current year. So if we take this data, notice they gave us basically the ending amount, what was resold. So this was the cost for S, which is going to be like the original cost, and then this is the cost for P, which is the added cost or the inflated cost that they have on their books, the amount that they purchased that inventory for, and then of course they resold that inventory. Okay, so let's go down to our data, and so I'm going to go on down and say, all right, let's go down to the data. This is actually going to be a prior year transaction, but instead of entering the prior year sales and then the amount that's resold, all we really need is the ending inventory items, and that's basically what they gave us. So they gave us the 68,000, basically the sales amount, and then they gave us the cost of goods sold, which was the 53,000. So the gross profit is going to be this 15%, and if we take the gross profit is going to be 15,000. If we take that 15,000 divided by the sales price, we get the gross profit margin of 22%, which may not be exact as well. So you want to be careful with the rounding, 15,000 over the 68,000. So yeah, that's not exact either. So just be careful of the rounding. So there we're going to use that information later. So we're going to move on from that at this point. We'll be pulling from it as needed as we go forward. Next, we want to take a look at the consolidated cost of goods sold for 2000 X4. What we're going to do going forward here is do a lot of the calculations that we're going to see in journal entries with basically tables. And this might be useful. Some people like to see it in this format, and oftentimes problems might give information in this format that can also be useful for supporting data in things like worksheets in practice. So we'll do some of these calculations basically in a table format. Then we'll take a look at the journal entries, and we'll be able to see how they look in terms of like a journal entry format as well. So we've added a little reveal screen to make this more exciting activity. So we have the consolidated cost of goods sold for 2000 X4. So we're going to be considering then the consolidated cost of goods sold. That's going to be this item down below. So we have the cost of goods sold recorded by P, the cost of sold recorded by S. We're going to add those up, and then we're going to have to adjust for them for those intercompany cost of goods sold items that we will need to be removing. So if I go back up top, we're going to say, all right, the amount reported by P is the 601. I'm just going to be pulling that over here in a table format now. That's the cost of goods sold on the trial balance for P, the parent. Then we're going to take the cost of goods sold, yes, for S as well, and add those together. So that's cost of goods sold recorded on the subsidiaries books. So those are the two amounts. So before we do any adjusting entries, the consolidation would be the sum of those two. Then we're going to have an adjustment for the unrealized profit in the beginning inventory, and that's going to be for the 15,000. Now we're going to get that from the worksheets that we put together previously, the colorful work. So here's the component that we need from that. Here's the ending inventory, and this was for the prior year upstream transactions, and we're looking at this 15,000. So in other words, there's the prior year upstream transaction. That means there's something in ending inventory for the prior year or the current year's beginning inventory that is gonna be sold in the current year, and there's gross profit inherent in it that's basically overstated because the inventory is on the books for too much, and therefore we're gonna have to reduce the cost of goods sold for the amount of the gross profit, that being the 15,000. So we're gonna be adjusting for that 15,000. That's gonna be a negative, and then we're gonna have the adjustments for inventory purchased from S and resold during 2000 X4. That's going to be this information here. So we have the current year downstream transactions, and we have the cost of goods sold. This is current year transactions of this 49,000. So we're going to make an adjustment for that 49,000. So we're going to have the 49,000 here. Then we're going to have the cost of goods sold recorded by S. Now this gets a little bit tricky because the way we're setting this up, notice we have the downstream transactions, sales, cost of goods, gross profit, and then we have the amount that's resold in terms of sales, cost of goods, gross profit. But we're really using the same terms as the items up top, so the same units of measure of the sales happened up top to figure out, you know, the same related sales down here, and then what would be in the ending inventory. What was actually recorded on S's books with regards to the resale price when S resold it, they resold this information for basically the amount that they paid for it, which was the amount up at the 69,000. So in other words, if I take this sales price represents the sale happening here, but on S's books, this is going to be the cost. And so that's what they're going to be reselling it for. So they would have cost of goods sold of basically the amount that they resold, not really related to this cost of goods sold, which is matching the same units of measure as here, but related to what they paid for it, which is actually this $37,950. So then we're going to have the $37,950 that we're going to make an adjustment for. So the total amount that was recorded by S and P is going to be the $86,950. We're basically thinking, okay, we're going to reverse what was recorded and then record the amount that's going to be the proper amount on using the proper basis, the proper cost of the cost of goods sold. So the cost of goods sold based on P's cost. We need to enter the cost of goods sold based on P's costs, not on S's costs, because S's costs are inflated. So we're going to say, all right, then the amount P sold was that 69,000. So we got the 69,000 was sold, and 2,000 x4 S is still holding on to the 31,050. So in other words, this 31,050 is what has not yet been sold at the end of the day. And so we have the difference of the 37,950 amount P sold. So we're going to compare that to the amount that P sold, and we get basically the 55% ratio in terms of the amount resold. In other words, 37,950 divided by the 69,000. So 55 is the percentage that that was sold, amount P sold to S. So then we're going to say that was resold. So P purchased inventory for 49,000. So the original cost then, that the purchase of the inventory, 49,000, was what? Now we're going to take the percentage of that and say, well, the percentage of the 55% times 49,000, we have the 26,950. So then we're going to say, okay, then our adjustment, what we're going to say is we've got the 601, the 222, and the 15, and then we're going to make our adjustments down here, which is going to be the 49,000 and the 37,950 are basically the amounts that we're going to remove because they're not at the proper basis or cost units that we need, and then we're going to put them back on the books for the amount that they should be on the books for, which is the 26,950. In other words, if we take the 86,950 minus the 26,950, we're going to get this $60,000 adjustment. So now I'm going to take what we had before. This is what recorded by P, what's recorded by S. We're going to reverse this 15,000, and then we're going to take into consideration the $60,000 adjustment. So we're going to say, all right, this is what's on the books for P. 601, that's not right. 601,000 plus 222,000 minus the 15,000. And then I'm going to jump back down here because we summed this up to the 60,000. So then we're going to say that is equal to the 808 minus the 60,000. And that's going to be the 748,000. So we would expect then cost of goods sold, end of the day, this number down here at the end of the consolidation worksheet to be that 749,000 as it will be. Or 748,000 is what we should have there. Okay, so now let's see the next worksheet that we're going to have. Consolidated inventory balance. So we got the consolidation inventory balance. So we're going to now be considering the amount that's going to be in inventory. Once again, working it with a table, then we'll basically kind of reconstruct this with the journal entries. Inventory up top, and this is what's recorded by P, what's recorded by S. Then we're going to have to do our consolidation entries, and then we're looking to see what will be there at the end of the day after those entries have been taken place. So we've added our reveal item again, and so once again, we're going to start with what's on the books. What's on the books for P for inventory, so that's going to be the parent. That's going to be the 183. We're going to be adding that to what is on the books for S, which is going to be the S inventory subsidiary 124,000. That's going to give us our total consolidated inventory at that point, 307, that we're going to have to make adjustments for the elimination or consolidation entries. Then we have the unrealized profit in ending inventory held by S. So we have 2,000 X4 current year. S is still holding on to 31,050 of basically these intercompany transfer inventory. In other words, we got that from our data. I'm scrolling up top to this ending inventory for the current downstream transactions. S is still holding on then to the 31,050 of the 69,000 that was originally the transfer amount. So we can use our ratio analysis there again. We can say, all right, there's the 31,050. If I compare that to the 69,000, we're going to get a 45%. That 45%, of course, being calculated with the trusty calculator at the 31050 divided by the 69,000. There's the 45%. We're going to take that 45% and multiply it times the gross profit, the 20,000. So the 20,000 here, that's going to be in the original sales amount, because we need to basically remove, the portion of the gross profit that's included or is inside that ending inventory number. So we're going to say, all right, the gross profit, we need to remove 45% times 45. So I'm going to say times the 20,000, and that's going to bring our adjustment for that 9,000. That's going to be the unrealized profit in ending inventory held by S. And then we got the consolidated balance, which of course then will be this outer column of the total inventory that we had, 307,000 minus the 9,000. That's going to be the 298,000. So that 298,000 then is what we would expect to see and will see once we complete the consolidation and elimination entries for inventory. It's going to be the ending result here. We're just doing it in the table format. Okay, let's see what else we got. Let's move it on down. Now we're going to do a computation of interest expense. So similar kind of thing that we're going to be taking a look at. We're going to be considering interest expense. If you think about our adjusting entries, we're thinking about the income statement account here. Now, it might be a little bit more difficult to see the interest expense directly on the table because, there's going to be different interest items that could be involved down there, and we're dealing with the temporary account. There could be more than just the interest expense of the intercompany transactions, but we're going to be looking for the computation of those interest expense related to the bonds. Okay, so now we're going to be considering this data over here, where S issued bond on January 1st, 2000 X1, face amount 190,000, the interest 8%, the year's 10%, issued at 104 or 104%, meaning we have a premium on it. So now let's consider what would be recorded then by S with regards to this. And then later on, we got to deal with the situation that P then purchased some of S's bonds from a third party. So we're going to say, all right, well, normally you'd have the par value of the bonds issued are going to be the 190,000. Then you'd have the rate is going to be that 8%. So the interest payments you would think then would be the 8% times the 190 or 15,200. Then we're going to look at the amortization of the premium. So the premium calculation, because it was sold at a premium, that face amount of the 190,000 times the issued at, which was the 104, which basically means 104%, or 190,000 times 104%, or 1.04. That's going to give us the amount of the 197.6. In other words, this is how much was received for the bonds face amount 190,000, difference then being the 7,600 over the face amount of the bonds. That, of course, is the premium. Then we're going to have to deal with the fact that we're going to have to amortize the premium. So the premium, we said there's 10 periods involved here, I believe. Is that right? Yeah, 10 periods. And so we're going to take that 7,600 divided by 10, and that's going to give us the amortization of the premium that we're going to have per year. And then the interest expense then is going to take into consideration the premium. So we're going to have the 15,200, the face times the rate times which is the 15,200, and then subtracting the 760 to amortize the premium. That means we'll have interest expense recorded by the issuer of the bond at 14,440. So that's without considering or taking into consideration kind of this issue that then P bought them. That's going to be information that we can take into consideration and use when we then do our elimination entry, because we're going to have to consider the portion of that interest expense that is applied to intercompany interest for P purchasing the bonds from a third party. Now let's think about the interest income that would just be normally recorded by P on P's side of things that purchased the bond. Now they didn't purchase the bond, remember, from S, which would be a lot easier. It would be nicer if that was the case, but no, they purchased it from someone else, even though it was S's bonds. So what would they be recording without considering the consolidation entries? This will help us with the consolidation entries later. So P purchased bonds from one of the original owners on December 31st, 2000 X4 or X2. So that means this was the original bond. Then these guys purchased it S's bonds from somebody else. So face amount of the bond, 76,000. So the original bonds were 190. They only purchased 76,000 of them, and they purchased it for 74,480, meaning they paid less than the face amount of the bonds that they purchased. Therefore, they're going to record it on their books as a discount. So we're going to say, all right, they got the face amount of the 76,000. Interest rate still that 8%, so they're going to be getting 8% on the bonds that they have of them. Annual payment received then 6,080. Then we've got basically the discount that we're going to be amortizing on this because they bought it in essence at the discount. So the bond face amount is going to be the 76,000. They purchased it for the 74,480. The difference between the two means that they paid less than the face amount by the 1,520, in essence the discount. Then we're going to divide that by the number of periods. Now be careful, it's not 10. Why? Because they purchased it 2 years later. It was 10, but then we have 1 and 2 minus the 10, 10 minus the 2, there's 8 periods left. So now we're going to say there's 8 periods left that they're going to be amortizing that over. That means the 1,520 divided by the 8 is the 190 of the amortization. So the interest income for 2000x4 then is going to be the 6,080 and the 190, or the 6,270 that would then be recorded by P with regards to the bonds that they purchased. Again, we're going to have to use that in our consolidation entries. Now we're going to go to the computation of the constructive gain on bond retirement. Computation of the constructive gain on the bond retirement, a result of P purchasing the bonds basically from the third party here. Okay, so we're going to say the par value of the bonds outstanding are the 190,000. That's the original issue of the 190,000, even though the purchase of the bonds was 76,000 by P. The original issuance is the 190,000. Bond premium on December 31st, 2000x4 is what our initial calculation will be. Why? Because in 2000x4, that's going to be the year that we have the consolidation. So we're going to be calculating this as of the year of the consolidation. So we have the premium, the original premium of the 7,600, which of course is the 190,000 times 104% minus the 190,000, the amount that was paid over the face amount at the original payment times 10 periods, the amount of periods originally. That would give us the amortization, as we saw before, of the 760. So then we're going to think about the periods that have passed. 4 periods have passed. What does that mean? We have 2000x1, 2, 3, and 4 for the current period we're working in on 2000x4 of consolidation. That means that the amortization as of December 31st, 2000x4 is going to be that 3,040. That's going to be the amortization amount. So then if we take the bond premium, the 7,600, minus the amount that's going to be amortized up until that 4-year time period, we still have the amount that is unamortized as of December 31st, 2000x4, the time that we will be doing the consolidation of 4,560. So remaining years to maturity are now 6, because there was 10 original years minus the 4, 6 periods remaining. We're just going to take that 4,560 divided by 6 to get us back to that 760. We're just basically getting back to that same 760 because we're using a straight line method. Then we're going to be taking the years to maturity at the point of purchase. So the point of purchase, meaning when P purchased the bonds over here, they purchased them in X2, December of X2. So that's January, we got X1 and X2. So 10 minus 2 years, or 8 years. So we got 8 years there that we're going to be dealing with. The premium for December 31st, 2000 X2 then is going to be 6,080. So that's basically the total premium that would be on the books for as of the point in time that P then purchased the bonds from a third party. Now, they didn't purchase all of the bonds, so we're going to have to take some ratio, some proportion of that number then. So the book value of the bonds then is going to be that 190,000 at that point, and then the 6,080 to give us the 196.80, and then the proportion that was purchased, was, and we can go back up here and just do a little ratio analysis. We're just going to say, all right, how much did they purchase? They purchased 76,000 face amount of divided by the 190,000 original amount, which is about 41. It's not perfect. about 41%. So scrolling back down, and we have 40 down here. Let's do that one more time, because I think it should be even. It was 76,000 divided by 190,000 is 40%. All right, 40%. That's what I was expecting to see. So I'm going to go down and say, okay, now we got that 40%, and that's going to be the book value of the bonds purchased then is going to be the 78,430. And the purchase price was how much? So this is what you would expect, you know, the amount to be paid if there was no like premium, or if it was the same, if they were using the same amounts here. But they paid then for it the purchase price of 74,480, which was this amount. So now we have this difference that we're going to have to be dealing with, which is going to be that 3,952, and that's going to be the constructive gain that we're going to have to be dealing with within our consolidation. That's one of the most confusing kind of components with this bond type of thing. We'll see how that will take into consideration with regards to our elimination entries in future presentations. Next, we're going to go to the Intercompany Premium as of December 2000X4. So we'll do a similar calculation with regards to the premium to see what the Intercompany Premium is going to be as of 2000X4, because we're going to have to basically eliminate the portion of the premium that is basically the Intercompany Premium. So we're going to be taking that 6,080, which is the premium for December 31st X2 that we calculated up top. So we're going to take that amount. We're going to take the proportion purchased was 40%, same ratio that we have up top, same ratio. And so the Intercompany Premium as of 2000X2 is that 2,432. 2,432. We're going to divide that by the same number of periods at the point in time that P purchased these, because they purchased it 2 years into the 10-year time period. So that's going to be 8 periods. So we'll take the 8 periods. We'll take the 2,432 divided by the 8 periods. That's going to be the 304. 304 years that have passed since that point in time. 2, right? It's been 2 years since P made the purchase, which they made in 2000X2. So we got 3 and 4. So it's been 2 years. So that means that the amortized since 2000X2 is going to be that times 2, or 608. So the 608. Then we have the Intercompany Premium as of December 2000X4 is going to be the 2,432 minus the 608. And that'll give us the 1,824. Amount assigned to the non-controlling interest is our next calculation we'll be taking a look at. I'm going to scroll down to our trial balance, where we have the P company and S company parent subsidiary trial balances. We're looking at this item down below, this non-controlling interest in the net assets. We're going to see what the end calculation will be after we do the consolidation entries we will be doing shortly or in the next presentation. So we're going to start off looking at the equity section, basically, of our S's books. Let's scroll back down, just take a look at the equity section. We're going to be picking up then the common stock, the 40,000, the retained earnings, the dividends, and then basically the net income of the 89,000, and look at basically the net assets or the equity section as of this point in time. Then we'll consider breaking that out into the non-controlling interest and the adjustments that we will need. So there we have our items. So we have the common stock, the beginning retained earnings, the net income, and the dividends. So in other words, if we were to add this up, we've got the 40,000 plus the 160,000 plus the 89,000 minus the 21,000. That would give us our 268,000. You can consider this in a couple different ways, and this is similar to our first journal entry. We'll take into consideration some of these components as well. So we're going to say, all right, that 268,000, we should be able to calculate assets minus the liabilities, which would be the 68,800 plus the 110,000 plus 32,000 plus 124,000 plus 47,000 plus 267,000 minus 61,000 minus the 114,240 minus 11,000 minus the 190,000 minus the 4,560. And that should give us that 268 as well as what we did here is basically take the equity. The equity section will match the same amount. So if we took the equity section, 40,000 plus the 160,000 minus the 21,000, $88,000. And then the revenue and expenses are summed together as that $89,000. So I could just add then the $89,000. That would be the $268,000. Now you would think you would take that $268,000 and just take the proportion of it, the 30% applied to the non-controlling interest. But of course, we're going to have some adjustments that we will need to do for the consolidation process. So it's not that easy. So then we're going to take the next thing that we're going to include here is the constructive gain. Now we calculated the constructive gain up above at that 3,950, which we calculated up here. So we're going to take that into consideration. We're going to have to include that. And then we have the 2 years amortization of the gain, which is just simply taking that 3,952 divided by I think it was 8 times the 2 years, right? Because there were 8 years since the point in time that this thing was purchased, and then 2 years have passed. So this divided by 8 times 2 is at 988. Now this will make a little bit more sense. This is a little bit confusing no matter how you think of it, but you know, this constructive gain is kind of that difference because of that third-party transaction, which is going to have to basically, it's kind of going to go away at the end of it. So we're basically amortizing it. And so we have the 988. So again, this might make a little bit more sense once we start looking at the journal entries related to it. But that's what we have there. So then that means that if we were to add these up, 40,160 plus the 89 minus the 21 plus the 3,952 minus the 988, we're going to get to that 270,964. Then the non-controlling interest percent was the 25%. Is that right? I thought it was 30. Let's go all the way up top. Pick up, yeah, 25 and 75. So it's not 70-30, it's 25 and the 75. So let's scroll all the way back down there. I had to check, I should have probably paused to check that. So if we take that 270,964 times the 25%, we're going to get the non-controlling interest of the 67,741. And that is the amount that we expect to see once again down here, non-controlling interest, after we do our consolidation entries for it. Now let's consider the income assigned to the non-controlling interest. So we looked at this number. Now we want to look at basically this number down below, what we're going to think that's going to be at the end of this process. Once again, we'll see kind of some of this when we start to do that first journal entry, when we make some of these adjustments, so that we'll kind of repeat some of that in there. But we want to look at this with regards to a table. So we're going to say, all right, there's that 89,000. There's the net income for S that we would think we would just be allocating between the 25 and the 75 controlling or non-controlling and controlling interest respectively. But we're going to have some adjustments we need to make to it. So that 89,000, we're going to have the adjustment for realization of profit on inventory sold to P in 2000X2. That's going to be including this transaction we saw when we did those intercompany inventory transactions. We're picking up this 15,000 once again. Then we're going to have the adjustment for realization of constructive gain on the bond retirement. That's going to be the 494, and that's going to be the constructive gain that we had up top, which was this. We can get it from, this is where we actually calculated it at that 3,952, and then divided by the number of periods of 8 periods remaining. So that means we're going to basically amortize it in essence, or depreciate it, or over the 8 years for the 494. So we've got the 494 is going to be the adjustment, and then the realized net income of S for 2000X4 is going to be the 301,506. So in other words, here's the starting point. The 89,000 is their net income. We're going to adjust it 15,000 minus the 494 to the 103,506. Then allocate that out to the 75 and the 25 controlling and the non-controlling interest. We're considering here the non-controlling interest, so the proportion of ownership held by the non-controlling interest being the 25. So if I take that amount and multiply it times 0.25, 25%, we get the 25,877 about, and that's what this ending number we expect it to be at the end of the day. Note that this date, I think this might need to be 2000X3, the prior year inventory information, at 50,000 that we've used to calculate in the past. So just, keep that in mind. But here's the calculation for it. There's the 15,000 for that adjustment. Now, next thing we're going to do is we're going to be taking a look at the transactions related to the intercompany bonds. And then we're going to move forward from there and finally do the consolidation process. We're going to do that next time in the second component of this practice problem.